For a few hours in June of 2026, on a corner of the financial system most people have never heard of, a rocket company briefly became more valuable than Amazon and more valuable than Microsoft. Not because it suddenly launched more satellites or signed some enormous new contract. A short squeeze in crypto-based perpetual futures, contracts that let traders bet on a stock's price around the clock without ever touching the actual shares, pushed SpaceX's implied valuation to roughly $3 trillion before the number came back down to earth almost as fast as it had gone up. That single number set off a genuine debate among economists, fund managers, and at least one famously skeptical hedge fund manager about what exactly is being priced into markets right now and whether ordinary investors who have never bought a single SpaceX share are quietly exposed to all of it anyway. Here are 5 things about this story that actually matter, counting down to the one that affects almost everyone with a retirement account, whether they realize it or not. Number 5. The math behind this valuation does not look like a normal company's math, and that gap is the whole story. SpaceX went public on June 12, 2026, pricing its initial public offering at $100 to $35 a share, raising in the neighborhood of $75 billion in what instantly became the largest IPO in American stock market history. At its opening valuation of roughly $1.77 trillion, the company was trading at somewhere around 100 times its trailing annual revenue of about $18.7 billion. For comparison, when Google went public in 2004, it priced at roughly 10 times sales, during a period when its revenue was growing well over 200% a year. When Meta, then still Facebook, went public in 2012, it priced at roughly 28 times sales. SpaceX's revenue grew an impressive but far more modest 33% over the past year, and the company posted a net loss of close to $5 billion over that same period. A price-to-sales ratio above 100, attached to a company that is still losing money, sits in territory that historically only a handful of companies have ever occupied, and almost none of them sustained it for long. Number 4, a meaningful chunk of that valuation is being justified by a business SpaceX has barely started yet. Much of the bullish case for the company increasingly leans on its connections to artificial intelligence, infrastructure, folding ambitions around Starlink-based data centers, and ties to Musk's broader AI ventures into the investment pitch. SpaceX's AI-related division reportedly brought in only about $3.2 billion in 2025, a small fraction of total revenue. Yet some Wall Street estimates, including projections from Goldman Sachs analysts, have floated figures suggesting that segment could grow to over $300 billion in revenue by 2030, an extraordinary acceleration that would require nearly flawless execution in an AI industry where competition between OpenAI, Anthropic, Google, Meta, and several well-funded Chinese firms is already driving prices down rather than up. Investors are not just betting on rockets and satellites here. They are betting heavily on a still unproven AI business, scaling roughly 100-fold within half a decade. A forecast, not a fact, that is doing a significant amount of work in supporting today's price. Number 3, the world's most famous skeptical investor looked at this valuation and chose not to bet against it. And that restraint is more revealing than an outright prediction would have been. Michael Burry, who built his reputation correctly forecasting the 2008 housing collapse, examined SpaceX's run toward a near $3 trillion valuation and called it, in his own words, fundamentally a small space company, pointing out that at that price, SpaceX's market capitalization alone could theoretically buy out a long list of the world's wealthiest billionaires combined and still leave roughly $1 trillion left over. He considered specific trades betting against the stock and ultimately passed on all of them, explaining that he was neither short nor, in his words, long the position. Burry's stated reasoning matters here. A stock propped up by an extremely thin available float, intense retail enthusiasm, and structural buying from index funds can stay disconnected from traditional valuation math for far longer than fundamentals alone would predict, making it a genuinely difficult and risky position to bet against directly, even for someone who clearly believes the price doesn't add up. Number 2, this valuation arrived inside a market that was already showing signs of broader strain, not in isolation. In the same month that SpaceX's valuation captured headlines, the so-called Magnificent Seven technology giants, along with chipmakers like Broadcom and AI infrastructure names like Oracle, collectively lost roughly $2.7 trillion in combined market value, according to reporting based on Yahoo Finance data. Trading volume in short-dated stock options, the kind of instrument that lets traders make highly leveraged short-term bets on where a stock is headed, within days rather than years, has roughly doubled since 2020, a pattern some economists have compared directly to a rise in pure speculative gambling rather than traditional investing. Several commentators, including analysts, referencing The Economist's own reporting on what they describe as a manic phase of the current bull market, have drawn explicit parallels to the dot-com bubble of the late 1990s. noting that investors today are making remarkably similar arguments about why elevated valuations are justified this time, built around artificial intelligence rather than the internet, but following a strikingly familiar pattern of reasoning. And number one, the part of this story that touches almost everyone, even people who have never looked at a stock ticker in their life. Index funds bought SpaceX automatically on your behalf, whether you wanted them to or not. In the weeks before SpaceX's IPO, NASDAQ introduced a fast entry rule allowing sufficiently large new listings into its flagship NASDAQ 100 index after just 15 trading days, down from the much longer waiting periods that used to apply. FTSE Russell went even further, adopting a rule permitting large IPOs into its widely tracked Russell indexes after only 5 trading days, a window so short it overlaps directly with the period in which SpaceX's own underwriters are still legally allowed to support the stock price through market purchases. Only the S&P 500 held the line, keeping its existing requirement that a company post actual profits before joining, a bar SpaceX's nearly $5 billion annual loss could not clear, pushing potential S&P 500 inclusion to 2027 at the earliest. But NASDAQ 100 and Russell inclusion alone were enough to trigger automatic, contractually mandated buying. From funds managing well over $1 trillion in combined assets, funds that exist specifically inside the retirement accounts, 401k plans, and target date funds that tens of millions of ordinary people rely on without ever actively managing them. Here's why that mechanical detail matters more than almost anything else in this entire story. Only somewhere between 3 and 5% of SpaceX's total shares were actually available for public trading immediately after the IPO, with the rest, including Elon Musk's roughly 42% personal stake, locked up under standard restrictions until well into 2027. That means the wave of automatic, rule-driven index buying was aimed at an extraordinarily small pool of tradable shares, a setup that multiple trading firms and analysts compared directly to the kind of gamma squeeze dynamic that sent Tesla's stock sharply higher around its own S&P 500 inclusion in December 2020, except compressed into a dramatically shorter window and aimed at an even thinner float than Tesla had at the time. Pension fund overseers in New York City, managing combined retirement assets above $600 billion on behalf of teachers, firefighters, and other public workers, formally wrote to the index providers asking whether anyone had actually modeled what happens when billions of dollars in forced buying get aimed at a stock with this little room to absorb it. So here is what all 5 of these pieces add up to. A company with extraordinary engineering achievements and real, valuable businesses in reusable rockets and satellite internet went public at a valuation that, by traditional measures, leans heavily on a still unproven AI growth story. A famous skeptic looked closely at the math and chose caution over a directional bet, which tells you something about how unusual the setup really is. That valuation surged inside a broader market already showing signs of speculative excess, with the same justifications echoing arguments made right before previous bubbles burst. And underneath all of it, a handful of recently rewritten index rules quietly funneled a meaningful slice of this entire story directly into the retirement accounts of people who never made a single decision about it themselves. None of this tells you with certainty whether SpaceX's stock goes up or down from here, and nothing here should be taken as advice to buy or sell anything. What it does tell you is that the line between one company's IPO and the broader health of the market you depend on for retirement has gotten thinner than most people realize. And in this particular case, that line ran directly through your index fund, whether you noticed it happening or not. It's worth digging a little deeper into that comparison with the dot-com era, because the parallel isn't just a vague vibe being thrown around for dramatic effect. Back in the late 1990s, investors justified sky-high valuations for unprofitable internet companies by pointing to the internet's obvious, undeniable future importance, reasoning that traditional valuation metrics like price-to-sales ratios simply didn't apply anymore to a technology this transformative. Many of those companies were, in fact, building something genuinely important. The internet did transform the global economy almost exactly as predicted, and yet the overwhelming majority of the specific companies trading at those extreme valuations in 1999 still collapsed when the bubble burst in 2000, because being right about the importance of a technology and being right about the price of any specific company, riding that technology, turned out to be 2 completely different questions. Today's bullish case for SpaceX, and for a wider cohort of AI-linked companies trading at similarly extreme multiples, rests on a structurally similar argument: artificial intelligence and space. Infrastructure are obviously important and almost certainly transformative. Therefore, today's price, however extreme by historical standards, is supposedly justified by tomorrow's results. History doesn't say that argument is always wrong. It does say that argument has been made before, with comparable confidence, immediately before some of the most painful corrections in modern market history. There's also a detail worth adding about how unusually compressed SpaceX's own path to these index milestones really was, because it sets a kind of precedent other companies are now watching closely. FTSE Russell's new 5 trading day fast entry window and Nasdaq's accelerated 15-day rule were both finalized in the weeks immediately, preceding SpaceX's own listing date, a timing coincidence that several market structure analysts and at least one group of public pension trustees have publicly questioned. Once a rule like this exists on the books, it doesn't just apply to SpaceX, it applies to every sufficiently large IPO that follows, including a wave of other heavily anticipated technology listings, reportedly considering public offerings around the same period. Whatever happens to SpaceX's stock price from here, the rule changes. That fast-tracked it into major indexes are now a permanent part of how mega-cap IPOs interact with passive investing going forward, which means the structural questions raised by this single listing extend well beyond just one company's fate. It's also worth being precise about what actually drove that brief $3 trillion number, because the mechanism matters, and it's different from the kind of buying happening in regular stock markets. The spike came specifically from perpetual futures, contracts traded on crypto-native platforms that let traders take highly leveraged, round-the-clock bets on a stock's price without ever owning or trading the actual underlying shares listed on Nasdaq. When too many traders pile into bets that a price will keep rising, using borrowed money to amplify their exposure, and the price starts moving against the other side of those trades, exchanges can force those losing positions to automatically buy back in to close out their bets, a mechanical chain reaction commonly called a short squeeze. That squeeze briefly pushed the implied valuation on these specific platforms above $3 trillion, even though the actual regulated stock exchange price for SpaceX shares never reached that level during ordinary trading hours. The headline number that ended up everywhere, in other words, came from a corner of the market running on leverage and momentum rather than from the regulated exchange where SpaceX shares actually trade, a distinction that matters enormously for understanding what that number does and doesn't tell you about the company's real value. That distinction also explains why the number faded almost as quickly as it appeared. Perpetual futures markets can move violently in both directions, precisely because they're built on leverage rather than on the underlying mechanics of buying and selling real shares. Within roughly a week, SpaceX's actual exchange-traded stock price had fallen back about 28% from its peak, even as the index fund buying triggered by Nasdaq 100 and Russell inclusion continued working through the system on its own separate mechanical timeline. Two completely different forces, leveraged crypto speculation on one side and rules-based passive index buying on the other, were pulling at the same stock simultaneously for entirely different reasons, which is part of why this particular IPO has been so difficult for analysts to read using any single, simple explanation.